Hello everyone. My name is Steve Abbott. I am the head of government affairs and public policy for Gusto. We're here today to talk about the One Big Beautiful Bill and some of the implications for small businesses. I'm joined by my colleague Monica from Gusto and Nate Panning from BGM. They're going to be going into different aspects a little bit more specifically, but I'll kick us off and talk about sort of the broad strokes of the bill and what it does. But just a quick reminder, like this webinar in and of itself is not to be taken as tax, legal, or HR advice. It's just for informational purposes and to educate you. Please contact professionals for those types of things. Um, but then I'll hand it over to Monica and Nate to introduce themselves first, and then we'll get going. Monica?
Thank you so much, Steve. I appreciate it. Hello, everyone. As Steve mentioned, my name is Monica Joseph, and I am currently a compliance officer at Gusto. We will be talking about, the changes that have been made to the One Big Beautiful Bill, what's currently in flight, what's been proposed, and what we know now. So I look forward to speaking with my colleagues, and I will pass it over to Nathan.
Thank you. Hi, everyone. I'm Nate Panning. I head up the tax department here at BGM, also a tax principal myself. We'll be going over the business aspects, kind of the top level ones. There's a lot of stuff in this bill. So top level, big important things for businesses and also for individuals as well, flowing through to you on your own personal return. So we'll cover many things, not everything in the bill, but the top level things. And we only have an hour, not 16.
Great. All right. So, Congress has gotten into this mode this last, I don't know, I would say probably about decade of doing basically one major piece of legislation and doing a lot of things in it. And so the One Big Beautiful Bill made its way through Congress in record time. The provisions were largely negotiated behind closed doors. That was intentional, so they could sort of get agreement amongst the Republicans in the House and Senate to make sure that they could move it very fast. There was an intense back and forth starting in May, and then it passed out of the House. It was amended by the Senate. And then it required Vice President J.D. Vance to break a tie to send it back to the House, and then was signed into law on July 4th. So what does the big bill, One Big Beautiful Bill, actually do? There's two ways to think about it. There's what's been made permanent from what was currently in law or extended, and what's brand new. So let's start like the broad strokes of what stayed the same. The vast majority of this bill was making permanent the 2017 tax cuts. So it extended all of the changes in the marginal income rates and income tax brackets and made them to adjust with inflation. It permanently extended the 20% pass-through deduction under Section 199 and 199A. It made them permanent the employer contributions towards student loan repayment. And then also basically so in a way the bill preserves the tax baseline that many small businesses have grown accustomed to since 2018. So overall, like good thing because it provides some tax stability, and we're not facing another sort of cliff of income tax changes in the next 5 years or whatever time frame. So what's new? Some of the headlines include a temporary car loan interest deduction. They raised estate and gift tax exemptions. They increased the state and local tax cap. That's only a temporary one from $10,000 to $40,000 through 2029. And then in the first time in over a decade, there's a charitable deduction for non-itemizers. So even taxpayers who take the standard deduction can get credit for giving. And finally, the bill also creates these new Trump accounts. The guidance is still yet to be written on them, but it's kind of like a 529 adjacent vehicle for savings to be used for qualified expenses, but more expansive than just education. It can be used for down payment assistance on a house or to start a new business. And there's a few more employer-related benefits that I'll touch on here before handing it over to Monica. They made permanent the paid leave tax credit. That was a temporary pilot program. So this credit helps businesses cover the cost of providing paid family and medical leave. Employees must have worked for at least 6 months and average about 20 hours per week to qualify. And it's designed to work in concert with some states that have decided to expand paid leave programs. It also expanded the employer-provided child care tax credit. Businesses can now claim up to 40% of qualified expenses, and small businesses get a 50% rate. It's a huge opportunity for retention and attracting recruiting employees. And then health savings accounts were expanded. Previously under law, you could only get an HSA if you were covered under a high deductible healthcare plan. They've expanded them to be used on the individual ACA marketplaces with bronze and catastrophic plans. And the policy rationale there was because bronze and catastrophic plans have much higher deductibles and out-of-pocket maxes than your typical high deductible healthcare plans. So the idea was for people to be able to save in a tax advantaged account to guard against unexpected healthcare costs. And then finally, we got an increase in the dependent care flexible savings account. It had been since the 1980s at $5,000, and they increased it by 50% up to 7,500. So anybody with dependent care needs got a boost in tax advantage savings. And with that, I will turn it over to Monica to talk about some of the payroll related things.
Thank you so much, Steve. That was a lot of great information. And following in that suit with what has not changed and what has changed, I'm going to focus more so on the draft forms that have been made available that we know of right now. As of today, I'm not aware of that they've made any significant changes to those draft forms. Now, keep in mind, these are drafts, so they are subject to change or they may stay the same. But at minimum, because we do have information on the draft forms, it is advisable for employers to start planning around based on those draft forms, but with the caveat that it is subject to change. So what hasn't changed for 2025, although employers are required to report qualified tips, and that's tips that are businesses that pay their employees tips that are usual and customary in nature, as of December 31st, 2024. So if you were a business that paid your employees tips as of that date, then you would qualify for providing them a deductible tip benefit, so to speak. So for 2025, the Form W-2 has not changed. The Form 1099 NEC and 1099 miscellaneous has not changed, but employers are required to provide a reasonable approximation of what those qualified tips and qualified overtime earnings are. They can do that in a couple of ways. They could provide it on the W-2. It was announced in the notice 2025-62 that they can report qualified overtime in box 14 of the W-2. And for qualified tips, they could also provide the employee with a pay statement. They could provide the employee with a letter. So those are the different mediums in which the employer can communicate to the employee what their qualified tips and or qualified overtime earnings were. Notice 2025-62 also announced that in addition to a transition relief, employers have or given a penalty abatement, so to speak. And that is essentially saying that the forms or whatever media in which they provide this information, they're not holding them to it if it's not 100% accurate. And I say that in air quotes because, again, the goal would be that they provide their employees with a reasonable approximation. The cap for overtime is $12,500 for single filers. For joint filers, that's $25,000. For tipped employees, the cap is $25,000. Now, for 2026, it is going to be more regimented. It's not going to be as lax as 2025. The 2026 W-2 has had some updates to it. Again, I want to stress that these are drafts forms that I will be referring to. But the W-2 for 2026, the draft form, which is available on the IRS's website, there are new boxes as well as new codes. For the overtime, that should be reported in box 12 using code TT. And that again is going to be capped at 12,005 for employees who are single filers. Um, it's also based on the premium portion of OT that is paid under the Fair Labor Standard Act. So this premium portion of overtime is only based on federal. For employers that have nexus in states like California and that are subject to California overtime, if they pay overtime for hours worked in excess of a day, at 8 hours a day, then that would not qualify. If an employer has a more generous policy whereby they pay overtime for hours worked over 35 in a work week or over 37 and a half worked in a work week, that would not qualify. It's supposed to be based on the Federal Labor Standard Act guidelines, and it's only the premium portion of overtime. So overtime is at 1.5. It's only the premium portion of that that is considered deductible. With regard to the tipped portion of it, that the box 12 followed by code TP, that's where the employer would need to report the qualified tips. And the corresponding box that identifies that they are in an industry that customarily and regularly pay tips is going to be in box 14B. That's a new code. They would have to put in their Treasury tipped occupational code. That's new, and the Treasury has provided a list of what that is. I believe that may be subject to change, but at minimum, please refer to that list for information and to gauge whether you fall under that category, and it's going to be subject to the reporting requirement. As far as anything new, employees that qualify are employees that's paid through tip pooling, employees who are earn tips only when a service charge is distributed to the employee. That's when it would be factored into that $25,000 cap. Um, in addition to that, or I should say, contrast to that, for employers that fall under a specified service trade or business, this is like an accounting firm, a law firm, where they have employees that may receive an occasional tip, that should be reported on the W-2 as well, but it's going to be followed by code TS. Those tips do not qualify for the deduction, and the IRS wants to know about it. And the corresponding box 14B employer should use code 000 just to indicate again that they fall under the specified service trade or business. Really quickly, I want to be mindful of time. The 1099 NEC that has been amended in draft form right now to accommodate for the qualified tips as well as the cash chips. So with that, I am going to turn it over to Nate.
All right. Thank you, Monica. 1 second while I get the screen ready here. So the key items that I'm going to be going over today, like I said, there's a lot going on in this act, in this bill, but bonus depreciation 179, they're kind of interplayed with each other. The qualified production per property category that's tied into bonus depreciation related to manufacturers, the 199A that was mentioned earlier by Steve, R&D expense enhancement reverting back to 2021 rules, the SALT deduction, limitations on charitable deductions, the enhanced gift and estate tax exclusion, and then something on 529 plans. So I'll start with bonus depreciation. So from the first Trump bill in 2017, it's kind of been tearing down from 100% to 80 to 60. Under old law, it would be 40% bonus in 2025. Under new rules, it reverts back to 100% bonus, and that's permanent now. So that's built in. The place and service date needs to be on the day that Trump was inaugurated, January 20th or after. I think that was very purposeful. But yeah, anything that first 19 days of the year is not going to qualify for this 100%. It has to do the 40. So keep that in mind. You got to keep that in mind as well with cost seg studies, depending on when construction ended on certain buildings. But tied into this is also, I'll talk about a little bit more, the qualified production property category, which is related to manufacturers, big benefit, and I'll talk about that a little bit later. If for whatever reason you don't want to take the 100%, you can elect to take the lower amounts, the 40% or the 60, depending on when it placed in service. And then the mention on 179, which is like bonus depreciation, but there's factors of you need income to be able to take 179, whereas bonus depreciation, there is no income limitation. There might be basis limitation and other things that factor into it, but bonus doesn't have that income factor that 179 does have. And I will say that from a state standpoint, 179 is accepted or conformed to by more states than bonus. So being able to take more 179 is beneficial because you don't have so many differences with the state returns, which can add to the complexity of your business return or even your personal return, which could increase your fees for that return. So just a side by side, just showing the bonus depreciation rates, the tier phase out that was happening. Now it's 100%. The election wasn't there before, just because it was a tier phase out. And then the increase, the doubling to 2.5 million for the 179. That's big. And 179 for the most part is going to be on equipment, some leasehold improvements, sometimes a roof. It all depends on what industry you're in and what you have, but there's certain parameters that you can't write off an entire building with 179, unless it's a farm building. That's different, but we're not going to get into farm accounting on this one. And then another phase out that increased was you can add up to $4 million worth of property. Once you add more than 4 million, then that 2.5 million starts phasing out, kind of dollar for dollar, and you get it's trying to benefit the small businesses. But I mean, 2.5 million is no chump change. I'd say that. So the qualified production property, this is pretty much 100% bonus depreciation for build outs of like manufacturing facilities. So if you build a new building, you got a breakdown of the offices, the R&D lab, and then you got the manufacturing area. That manufacturing area qualifies for 100% deduction in the year that it's placed in service. You could possibly wipe out all income for that year. Things to think about if it is in a flow-through entity, you're going to be capped at 500,000 of loss from your flow-through entities, and then anything in excess is going to roll into your next year's as net operating losses with different restrictions, but it's not like you lose that loss. It's going to be restricted in that first year. So, and I compare it to some clients, they want to buy a plane or something like that, thinking that they're going to be able to wipe out all their income. It's not possible, depending on where their income is. But just remember, there's this caveat that there's the $500,000 limitation out there. So other parameters that have to be met with this, it has to be in the US, has to be originally used by the taxpayer. They need to build it. They can't just buy it and then take 100% write-off. They got to build it themselves, and then they got to start construction after the 19th of January 2025, and then get it started before January 1st, 29. And then it has to be placed in service by January 1st, 2031. For those that are into real estate investment or just that's your career, is in real estate, you're a real estate professional, I just wanted to show a breakdown of the benefits that those that use the cost segregation study, the benefits of what this tax bill does. So this example would be a 20-unit townhome community. It's in Minnesota. I've got the breakdown of how much is building, how much is land improvements. So land improvements would be a parking lot, sidewalks, uh, landscaping that's not by the building. And then personal property would be the appliances, the countertops, the cupboards, special hookups for the appliances. Those unique items have a lower life than the building, which on here is 27 and a half years. Commercial buildings is 39. But breaking this cost seg does a breakdown so that you can deduct more depreciation sooner instead of over the life of the building. So just wanted to show under the old law, the 40% bonus, after all the breakdown, after bonus depreciation and then regular depreciation, we've got about 475,000 of depreciation. Under new law, we bumped that up to 958. So you can see the difference in the tax. So tax savings goes from 176 to 355. So $179,000 tax savings. So in real estate, depending on what type of investor you are, it's going to affect you differently, but the benefit is eventually going to hit your return at some point, whether it be in the current or when this property is disposed of and you trigger the release of your passive losses. Changes the 199A deduction. So this was put in place because back in 17, they dropped the corporate rate down to 21%. So this is a way to not put the flow-through owners out of place. So what this basically is taking your flow-through income and giving you a 20% deduction for the most part. You need to have a certain amount of wages, you need to have a certain amount of property, depending on what kind of entity you have. But this is a little bit more lucrative. They've increased some phase outs. So if you're a manufacturing company, more than likely you're going to get this 20% deduction. If you're an accounting firm or an architecture firm, or you have your own consulting business or a doctor, you would be considered a specified service trade or business. So that's basically it's your know-how in you doing the work. That has special restrictions and phase outs. So if you make too much money in that, you're not going to get this deduction. What happened here is that they bumped this up by about 150,000 for married filing and jointly and 75,000 for single. So the ability to take this 20% has increased a good chunk, which is a positive for all taxpayers in that field. And then one other thing related to 199A that they added is that there's a minimum deduction of $400. So if you have 1,000 of QBI income, qualified business income, then you at least get a $400 deduction. And then just note that these changes take effect in 2026, so not with the 2025 return. So just a little side by side, nothing changed with the rate. It's been enhanced for specified service trader businesses and adding the above the line deduction for the $400 minimum. Next, talk about research and development expenses. So for 2022, 23, and 24, all these expenses needed to be capitalized and amortized over, they say 5 years, but it was really 6 years, just the way the math worked. So it's possible that we have manufacturers that their book income is, let's say, $1 million, but they had $2 million of R&D expenses. So their taxable income has just jumped to, let's, for simplicity purposes, up to $3 million. From a cash flow standpoint, that's not a good thing because you got to pay tax on, I'll call it phantom income. So those rules were hurting the companies here doing R&D to keep business in the U.S. What this new law does, it reverts back to 2021, where you can deduct all of it in the current year. And there's other pieces built into this so that you don't have to continue amortizing those expenses from 22, 23, and 24. So if you are a large business, so a large business in this case would be for the last 3 years, if you add up your revenue for the last 3 years and divide by 3, if that number is below 31 million, you are considered a small business. Anything above that, you're a large business. So if you're a large business, you can either take those capitalized expenses, take it all in 2025. or you can split between 25 and 26. If you're a small business, you have an option of going back to 22, 23, and 24 to amend and take those expenses as if this old law wasn't in place. And it's important to kind of analyze what's going to be the best year or best scenario to go down, because you might have a lower tax rate year in 2022 versus 25. So if you end up going to 22, so if you amend 22, you have to amend 23 and 24. It's just all or nothing for that amendment. So you got to look at, okay, what's going to be the best tax cash flow result? Which one should I pick? And then go back there. It's well worth the analyzation of it. I just made up a word. Sorry about that. Analyze, okay, what's going to give me the most cash back? I just did it with a client. They're possibly selling in 2025. If we went back to 22 and the amended route, they'd be out about $200,000 just because of the tax rates. So it wouldn't have made sense to go back and amend those returns. So just to make sure you're looking at that for your clients and giving them the best result. One thing to note, everything I was mentioning above, that's for domestic research and development. If the company is doing it off US soil, it's still subject to a 15-year amortization like it was in the past. So they're trying to push US-based R&D. So just a quick side-by-side, no more amortization for domestic, full expensing. The foreign still 15, and then you've got different options to how you want to release those old expenses that got capitalized. Key implementation or implications would be the cash flow. We don't have that difference in taxable and net income. There's going to be a difference because of other things, more than likely, if you have this R&D going on, but it improves it for the business. Now you don't have to front load paying tax on expenses that are going to eventually get deducted down the road. It's all going to match the same tax year that, it happened. Tax planning, you got a lot of flexibility, 3 different scenarios possibly with what's going to be the best result to get the most cash back. And then the compliance piece is simplified, with 22, 23, and 24, yeah, you have to make a separate asset, or you have to make a separate schedule tracking when everything was done. When am I going to be able to deduct this? When does this get released? And on top of that, you have to kind of do a allocation of expenses and figure out, okay, how much of this admin time is related to R&D, and then build that into your capitalized amount, which is a lot of extra work, which needs to be done if you're doing an R&D study, but just throwing that out there. All right, the SALT deduction, or state and local tax. People in the industry like to call it SALT because it's a fun acronym. But this got enhanced. So it was 10,000. So your income tax, sales tax, real estate taxes, and personal property taxes, that's all been capped at 10,000. Now for 2025 through 2029, it's been bumped up to 40. For 26, 27, 28, 29, it'll go increase by 1%. And then 2030, it's going to drop back down to 10. So like I mentioned, what falls into this SALT category would be income taxes. If you're not in a state that pays income tax, it could be sales tax that you pay on large purchases, or if you really want to track every single purchase, your total for the year, the real estate taxes, and then personal property taxes like boat tabs, auto tabs, motorcycles, etc. Some states have personal property taxes on equipment as well, so it depends on the state that you're in. So this is enhanced if you have AGI. I know it says modified AGI. I won't go into that calculation. We'll just say adjusted gross income. If it is above 500,000, then there is a reduction of how much you can take of that 40. So my example here, taxpayer makes 550,000 of modified AGI, and they've paid over 40,000 of SALT tax. So the excess above the $500,000 threshold is 50. So we take that 50, multiply it by 30%. That gives us 15,000. So we have to subtract that 15,000 from the 40 to get us to our new limit of 25,000. It won't drop below 10,000, but just know that it does phase out over time. Another thing that Congress was toying with was getting rid of a benefit that business owners had where the states allowed for state taxes to be deducted at the flow-through entity level, which gave the taxpayer a federal tax deduction for those state taxes. Whereas if they didn't pay it at the entity level, it'd be a personal tax payment and it would be limited to this 10,000 or 40,000. That's still in play. So if you're not doing it, make sure you're looking at it and taking advantage of that provision. I mentioned new limitations on charitable deductions. So what they've added is this 0.5% AGI floor. So in this example, $500,000 of AGI. 0.5% of that is 2,500. So that means to get a deduction at all, you got to get above that 2,500. This is if you're itemizing. So if you give 5,000, your deduction would be 2,500. So 5,000 minus 2,500 gets your deduction amount. On top of this floor, there's something called the 237 rule. Some might remember an old rule called the piece limitations, which kind of dropped your effective tax rate benefit by 3%. This one is going to do that, but 2%. So if you are in the top tax bracket, and top tax brackets would be a little over 640 for single and about 769 for married, filing jointly. If you are in that top tax bracket, your 37% benefit on the deduction drops to 35. Plus, you've got that AGI floor. So, moving parts, just pay attention to that. I mentioned planning opportunity after I just mentioned that they also added for the non-itemizers the above the line deduction for charitable. So if you're single, you can deduct up to 1,000 on above the line and 2,000 if you're joint, for married filing joint. So when I say above the line, that means it's not on what we call Schedule A, which lists like your medical expenses, your taxes, your interest, your charitable deductions. That's Schedule A. Above the line goes into the calculation of your AGI. So planning opportunities with this, if you're planning on making large donations in 2026, or even 27, depends on the size of the donation. I'd say to think about accelerating that into 2025 if possible. If you're sitting on a lot of unrealized gains in your brokerage accounts, this would be a good time to possibly use that if you don't have losses to offset. Or if you've got the cash and you want to accelerate it, do it in 2025. Just put in there, like, let's say someone wanted to give $1 million, just though 25 versus 2026, you lose $20,000 of tax savings just by doing it in 26 versus 25. So just keep note of that and do some planning if charitable giving is in the plans for the near future. Next, just want to briefly touch on the increased gift and estate tax exclusion. So it's about at 13.9 per person. And this was supposed to sunset and fall off in 2026, but they've now made it permanent. So 2026, that's jumped up to 15 million per person and is going to be indexed for inflation now. So for a married couple, technically, you two would have a $30 million exemption or exclusion to use throughout your lifetime. And let's say one spouse died, they used 1 million of it, they have 14 left. That 14 is portable and can go to the survivor, the widow or the widower, and they'll have 29 million left. Even if you don't, if the family doesn't have that much wealth, you got to keep in mind that some states still do have a state level estate tax. Minnesota is one of those lovely states that has that at 3 million, and they don't transfer. Like if you don't use that 3 million during your lifetime, it just drops off and disappears. It doesn't have the portability like the federal. So still got to do some planning if that's part of your world and you're blessed to have an estate of that size. So what that does, higher exclusion allows for more significant tax-free wealth transfer to the next generation or whatever generation or whoever you want to send that to. So um, just keep that in mind and talk to your favorite accountant or estate planning tax advisory folk and plan this out. I know sometimes it's not fun to talk about, but depending on what you have built up, it's very important, and you don't want to be doing it with three months to go. And the last one I wanted to mention, kind of, it's in the realm of wealth transfer, is that the 529 plan has been enhanced. I would say, old law, you could use up to $10,000 per year for K through 12 expenses. That's jumped up to 20,000, which I mean that's a great jump. And there's more things that are covered, like homeschool fees, test fees. Just if it's related to school, more than likely it's going to be covered. Not all computer equipment is covered, but um, on top of that, they've also added post-secondary credentialing. So studying for the CPA exam, CPE, to keep your credentials or your licenses. That's all been added to this, which is helpful because sometimes the beneficiaries don't go to college and they can't use this, or they aren't going to a private school and they can't use the funds. The movement of 529 plan funds is pretty simple and can be moved to whoever it needs to be, whoever you're related to, if you can control the funds. So I think a great enhancement there. And that is my section. So, Stacy, I believe we're opening up to a Q&A session if there are any.
Yes, if there's any questions, they could be submitted in the Q&A.
And with the silence, I'll just say that even without this bill, now is a good time of the year to reach out to your tax team or whoever it may be to just check in and see how the year's going. If even if there's minor changes, it's good to check in and make sure the cash flow that you need for tax payments is what you still expected. Um, there's always moving parts out there, so can't control everything. So I'd say it's fruitful to check in and just do some planning. That way, when your tax return is filed, you already know exactly what to expect, and you're just filing a form. So it's not fun to have surprises. It's not fun to call and say, "Oh, do you got $100,000 lying around? You got to pay that by tomorrow." So avoiding that is usually a good time. So I'm just going to throw that out there.
Okay, if there's no questions, we can end it. Or if there's any other topics related to the One Big Beautiful Bill that you guys want to discuss, feel free. No?
Another from my side, Stacy.
Okay. All right. And that'll be it. Well, thank you guys so much. Thank you, Steve, Monica, and Nate.
Thank you.
Thank you for
And
the
I hope everybody,
opportunity.
of course, I hope everyone has a good day. Thank you.
Care.
Mm.
Bye-bye.